In every market cycle, I've watched traders chase breakouts the way a child chases a paper kite, eyes wide, heart fast, and rarely noticing the shifting wind. And before we dive too far into this idea, let me say something that ties today's lesson to the previous video on Top Trader Reveals Wyckoff's best market strategies. Because what we're discussing now builds directly on the same quiet truths that guide every professional operator's hand. Now, why do most breakouts fail? Why does the public rush in just as the market is preparing to move the other way? My friend, it's because the crowd mistakes motion for meaning. They see a bar push above resistance and believe that price alone is telling the whole story. But price never tells the whole story without volume, without context, without the underlying intentions of the dominant operators. Have you ever noticed how a stock can appear strong at the very moment it's being sold to you? This is the trap the composite operator sets day after day. You see, a true breakout isn't just a bar above a line. It's a culmination of preparation, accumulation, testing, absorption. If you skip those phases, you're not reading a breakout, you're reading a feint. That's why so many traders lose their footing. They are reacting to the surface instead of studying the foundation beneath it. And I've always said the market rewards the student of cause and penalizes the follower of effect. Let's speak plainly. A breakout fails when there is no cause behind it. If the underlying preparation, the accumulation or distribution, has not built sufficient pressure, the move cannot sustain. You might ask yourself, but isn't a burst of volume enough to confirm strength? Not always. In fact, isn't it curious how some of the loudest volume spikes appear at the exact spots where amateurs buy and professionals sell? Ask yourself, whose side would you rather be on? Now, the rule I taught decades ago still holds. I look for the last point of support or the last point of supply before price springs or breaks. That moment, quiet, subtle, almost imperceptible, is the market's way of whispering the truth. Breakouts that come straight off the bottom, without tests, without consolidation, without retests, are almost always doomed. They lack the sponsorship of strong hands. And if strong hands are not in the market, what gives it the strength to rise? As you study your charts, notice how a successful breakout often comes back to test the level it just crossed. That test is the market's exam. Are you paying attention, or are you chasing? A test shows light volume, firm support, and no eagerness from sellers. Without such a test, the trader is stepping into uncertainty. Would you build your house on untested ground? And here is where mindset enters the picture. A trader who is impatient rushes into every breakout. A trader who understands value waits for confirmation, for quality, for evidence. Wealth in trading, just like wealth in life, is built not by speed, but by consistency and clarity. The market teaches patience to the willing and extracts tuition from the impatient. Haven't you ever found that your biggest losses came from acting too quickly? Midway through this discussion, I want to remind you how today's principle echoes the ideas from that previous video, Top Trader Reveals Wyckoff's Best Market Strategies. There, we spoke about how professionals operate quietly before they reveal their true movement. This same truth governs breakouts. The real move is prepared long before the public notices the price bar pushing upward. Let us go deeper. A breakout that fails often shows excessive enthusiasm, but not enough backing. Think of a crowd pushing through a narrow doorway. Lots of noise, lots of energy, but not much organization. The smart trader looks for orderly movement, for structural harmony in the chart. This harmony appears as higher lows, tightening ranges, and volume that shifts from effort to ease. If the breakout happens abruptly, without this preparation, it's likely an attempt to mislead the uninformed. And I ask you, how many times have you bought a breakout only to be trapped by an immediate reversal? How many times has the market made you feel foolish for acting on what seemed like clear strength? Don't blame yourself. The market is designed that way. It's a mechanism built by professionals to distribute their goods at the highest possible price. Your job is not to fight them, but to learn their language. Wyckoff's rule for catching real breakouts is simple: study the cause, not just the effect. The cause is the structure, the accumulation, the testing, the quiet absorption. the effect is the breakout. If the cause is small, the effect cannot be large. If the cause is disorderly, the effect will be unstable. And if there is no cause at all, the breakout is nothing more than a headline made of price bars. Now let's talk about discipline. It takes courage to ignore a flashy breakout. It takes restraint to wait for the test. But isn't it remarkable how the trades you wait patiently for often feel calm, while the ones you rush into feel tense? That tension is your intuition warning you that the groundwork is incomplete. True traders develop the internal wealth of patience, which translates into external financial stability over time. As you watch a potential breakout, ask yourself, has the market shown me absorption? Have I seen a spring or a shakeout that clears out weak holders? Has the composite operator had adequate time to build a position? If the answer is no, why should you believe the move will follow through? These questions are your compass. The market leaves clues, but only those who slow down will see them. And remember this, the strongest breakouts almost always feel uncomfortable to buy. They appear slow, quiet, even boring. The public ignores them because they lack excitement, but excitement in the market is usually a warning, not an invitation. Steady movement, proven support, clean tests, these are the footprints of strength. If you learn to identify them, you will find yourself aligned with the professionals instead of the herd. The crowd wants immediacy. The professional wants reliability. Which one are you becoming? When you catch a real breakout, one supported by a solid base, you're not gambling. You're acting on evidence. You're participating in a move that was prepared long before you arrived. And that mindset, that patience, is what builds both confidence and capital. Because in trading, it's not just about finding opportunities, it's about learning to ignore the false ones that drain your resources and your resolve. You see, trading is a business of waiting. Waiting for the right structure, the right relationship between price and volume, the right test. And as you wait, you cultivate a mindset of selective participation rather than reactive speculation. That shift alone can change the entire trajectory of your trading career. So as you look at your charts today, ask yourself, would the composite operator be buying here? Are the conditions ripe? Is the structure complete? Or am I being lured by movement that has no foundation beneath it? Most breakouts fail because traders leap before the ground is stable. But the professional watches, studies, evaluates, and only steps forward when the market has proven that it is ready to support the next advance. Most breakouts fail because they lack a genuine underlying cause built through accumulation or distribution, and this single principle sits at the core of every chart a trader studies, whether they realize it or not. When I say cause, I'm referring to the quiet, unseen preparation that the market must undergo before it can produce a sustained effect. In Wyckoff's language, the cause is the structural groundwork, the absorption of supply, the steady accumulation by strong hands, the controlled testing that confirms whether the path is clear. Without that groundwork, the breakout is nothing more than noise, a burst of motion that cannot carry its own weight. Think of it like a building. If the foundation is shallow, the structure may look impressive for a moment, but the first shift in pressure will make it crumble. A breakout without cause behaves in the exact same way. Many traders, especially those who are newer or impatient, believe that price alone is the signal. When they see price push above resistance, they assume strength. But have you ever wondered why the professionals rarely buy at these moments of public excitement? They know that a price bar by itself is only the surface of the story. The real story is written in the behavior that came before the breakout, the shrinking of supply, the quiet dips on low volume, the subtle higher lows that show steady accumulation. If these elements are missing, the breakout has nothing to fuel it. It is a rocket with no fuel tank, and you can imagine how long such a rocket lasts. The absence of cause is what makes the majority of breakouts fail almost instantly. You'll often see them pop above resistance only to collapse back into the trading range within a few bars. This behavior is not random. It's the signature of a move that lacked sponsorship from strong hands. Operators know exactly when the public is watching a level. They know traders have alerts set, waiting for a breakout. And because they understand how the crowd thinks, they often use these levels to distribute into that excitement. So while the average trader thinks the breakout is the beginning of a major trend, the professional sees it as an opportunity to exit at optimal prices. To understand why cause is essential, you must understand the principle of proportionality. Large moves require large causes. A shallow base can never support a grand advance. A trading range that lasted only a few sessions cannot launch a multi-week uptrend. When you see a breakout that is not backed by months or at least weeks of preparation, the chances of failure rise dramatically. And if you reflect on your own trading experiences, how many times have you bought a breakout only to watch it reverse almost immediately? That frustration is not because the market is unpredictable, it's because the cause was insufficient. Consider what accumulation actually looks like. It's not dramatic, it's not flashy, it's patient, quiet, and controlled. Strong hands buy gradually because they do not want to reveal themselves. They buy on pullbacks. They shake out weak holders. They test the lows with decreasing volume. They create a cause that builds pressure beneath the surface, like steam inside a sealed chamber. When the moment finally arrives, the breakout is not forced. It is released. It flows naturally from the structure that came before. And when you witness these kinds of breakouts, you'll notice something else. They rarely come with explosive, chaotic volume on the first push. Instead, they often appear steady, almost calm, because the heavy lifting was already done beforehand. This is why it's so important for a trader to study not just the moment of the breakout, but the entire environment leading up to it. Ask yourself, has there been absorption of supply? Have the swings been narrowing? Has volume dried up on the pullbacks? Has demand shown itself gradually before the breakout? If the answer to these questions is no, then what reason is there to expect a lasting move? Without cause, a breakout is only a picture on the screen, not a reflection of true market intent. And let's speak about mindset for a moment, because the lack of understanding around cause often ties directly into a trader's psychology. Many traders feel pressured to participate, afraid they will miss the move. This fear leads them to act on effects instead of studying causes. But wealth building in trading requires patience and selective action. The professionals do not chase. They wait for proof. They let the cause reveal itself through structure and behavior. If you want to trade like them, you must adopt the same patience. Emotional urgency has no place in a breakout strategy rooted in Wyckoff principles. When you learn to read cause, you begin to separate meaningful opportunities from trivial ones. You stop chasing the moves designed for the crowd and start focusing on the moves prepared by the composite operator. And as you refine this skill, you'll notice your trading becoming calmer, more deliberate, more grounded. You'll no longer feel compelled to buy every breakout you see, because you will understand that most of them are built on nothing at all. A real breakout is always preceded by structural preparation, not sudden price excitement, and this single truth explains more trading failures than almost any other principle in market study. When traders chase a breakout, simply because the price finally pushed above a level they've been watching, they're reacting to the effect rather than the underlying cause. But in Wyckoff's view, the market never moves meaningfully without preparation. The preparation is the structure, the quiet building, the careful testing, the deliberate behavior of strong hands. Without this underlying structure, the breakout is just a brief flare, a momentary burst that cannot endure. Think of it like a tree. If the roots are shallow, even the slightest wind can topple it. A breakout with no structural roots meets the same fate. When you watch the market, you'll see many moves that appear strong, but have no true foundation. These are the moments when the uninformed rush in, convinced that they are seeing the start of a trend, while the professionals quietly step aside or even sell into that enthusiasm. The public sees a breakout. The professional sees a lack of structure. And if you've ever wondered why a move that looked powerful turned into a failure almost immediately, it's often because there was no preparation behind it. The price simply leaped without any real support. Structural preparation takes time, and because it takes time, Many traders overlook it or grow impatient waiting for it to develop. They want the move now. They want confirmation now. But the market doesn't reward urgency, it rewards understanding. Preparation shows itself in the form of a trading range, accumulation or distribution, where supply and demand are quietly adjusting. It shows in the narrowing of price swings, in volume that begins to act more logically, in the presence of tests that confirm the strength of the position. Without these elements, the breakout is little more than a reaction to temporary enthusiasm. The strongest breakouts often look unimpressive at first because the groundwork was already laid. They don't explode upward in a wild rush. Instead, they begin smoothly, almost quietly. They may move out of the range on moderate volume, not excessive. They may pause after the breakout, forming a small test or consolidation that smart traders recognize as confirmation. These traits reveal that the move is not forced, it is supported. It is not manufactured, it is natural. And natural movements in the market are the ones most likely to continue. When you study charts deeply, you'll see that real structural preparation carries certain signatures that are hard to mistake once you've trained your eye. You'll see diminishing supply on down bars, indicating that sellers are losing interest. You'll see demand stepping in more consistently, showing support at higher lows. You'll see volume dry up at the right times and expand at the right times. All of these elements create the pressure required for the breakout to become something more than a temporary event. Without them, the market has no reason to follow through. Ask yourself, how many times have you bought a breakout that seemed explosive, only to watch price fall back into the range within minutes or hours? That experience is not because breakouts are inherently unreliable. It's because most breakouts occur without the proper structure. The chart may look exciting in the moment, but excitement is not structure. Structure is calm, logical, and patient. The best operators in the market are not searching for excitement, they're searching for evidence. And evidence is found in the preparation, not in the sudden movement. A trader who learns to read structural preparation begins to see the market differently. Instead of reacting to every breakout, they evaluate whether the breakout was supported by a proper base. They look for signs of accumulation, signs of absorption, signs of testing. They watch the character of the trading range and ask whether the market has built the cause necessary to justify a sustained advance. This mindset doesn't just improve accuracy, it builds discipline. It protects the trader from emotional impulses and keeps them grounded in the logic of market behavior. And this brings us to the psychological side of trading. Many traders lose money not because they misunderstand price action, but because their mindset drives them to seek immediate confirmation rather than patient analysis. They want to feel the thrill of catching a move early, even if the move is not supported by the structure. But the professional mindset is different. It values the base, the cause, the preparation. It understands that wealth grows from well-supported decisions, not from impulsive entries. When you learn to respect structure, you also learn to respect patience, and patience is one of the few traits that consistently separates successful traders from frustrated ones. Structural preparation also helps you avoid false signals that are created deliberately by strong hands. Operators often push price above a resistance level briefly to trigger public buying. But if the move lacks structure, that push is simply a tool, a tactic to create liquidity for the professionals to sell into. When you understand the importance of preparation, you no longer fall for these traps, because you can see that no real cause was established beforehand. If you begin training yourself to look beneath the breakout, to study the structure that leads to it, you will find that your entire approach to trading becomes more stable. You will no longer be swayed by sudden price movements or missiled by dramatic surges. Volume spikes at resistance often signal distribution, not strength, and this is one of the most misunderstood realities in the market. Traders see heavy volume and a breakout attempt and immediately conclude that the stock must be strong. After all, isn't big volume supposed to confirm big demand? But if you look more closely, really observe the character of that volume, you'll often notice something very different happening. What appears to be demand is frequently nothing more than the last burst of public buying, the enthusiasm of traders who have been waiting for the breakout and finally rush in, and who sells to them at that exact moment, the strong hands who accumulated earlier and are now distributing into that excitement. When price reaches a well-known resistance zone, everyone is watching the same level. Alerts go off. Traders lean forward. Social media lights up. That concentration of attention creates the perfect opportunity for professionals to do business. They know that breakout traders will buy as soon as the price pushes slightly above the line. They also know that many traders place their buy-stop orders just above those obvious highs. When those orders trigger, volume spikes, not necessarily because smart money is buying, but because the public is rushing in all at once. Meanwhile, the professionals quietly unload their inventory, using the crowd's enthusiasm to mask their activity. Have you ever noticed how volume surges sharply during a breakout but then stalls immediately after? That stall is the tell. The demand wasn't genuine, it was emotional. Distribution at resistance is not usually loud or dramatic. It's strategic. Professionals want to sell at the highest possible price without revealing their intentions. And what better time to sell than when the public believes a new trend is starting? This is why Wyckoff always asks traders to study the context, not just the bar. A surge in volume at resistance means nothing in isolation. You must ask who is more likely behind this activity. Is it the composite operator accumulating quietly near the lows, or the masses chasing price near the highs? The answer is usually obvious, but only to the trader who takes the time to understand the story behind the chart. The market has a rhythm, a structure, a logic. If volume is expanding dramatically right at the point where supply is expected to appear, you must be cautious. Strong hands do not usually rush into a position at resistance. They build positions in periods of uncertainty, not during moments of excitement. If the breakout were truly their doing, you would often see the groundwork beforehand, narrowing ranges, decreasing supply on pullbacks, orderly tests. When these precursors are missing and yet volume explodes at resistance, you can be almost certain that distribution is taking place. Let's talk about the emotional side of this, because emotions are tied deeply to volume spikes. When price finally reaches resistance, many traders feel validation. They think, this is it. This is the move I've been waiting for. That emotional confirmation creates urgency. Suddenly, instead of waiting for structure, they feel compelled to act. But urgency is exactly what strong hands rely on. They understand that the emotional trader provides liquidity that allows them to sell large positions without disrupting the market too visibly. So the volume spike you're looking at may not be strength at all. It may simply be the climax of public enthusiasm. Think of it like an auction. When a rare item is about to be sold, the bidding frenzy often happens at the very end. Everyone wants in at the last moment, driving the price sharply upward. But the professional collectors, the ones who truly understand value, made their decisions quietly, early, and with discipline. The final surge in bidding doesn't indicate value, it indicates the end of opportunity. Volume at resistance behaves in much the same way. It is often the final push, not the beginning of a genuine move. A trader who learns to recognize this dynamic gains an enormous advantage. They stop assuming that every large volume bar is bullish. Instead, they read the character of the bar. Did price close well above resistance, or did it merely poke through before falling back? Did the volume expand smoothly as part of a developing trend, or did it surge suddenly as if triggered by herd behavior? Did the breakout follow a well-formed structure, or did it appear out of nowhere? These distinctions matter because they reveal whether the activity is accumulation-driven or distribution-driven. Another important clue is how price behaves immediately after the volume spike. If the breakout is real, you should see continuation or at least a constructive test. But if the breakout is false, the price will often hesitate, then drift back into the range. That hesitation is the footprint of supply. The professionals have finished distributing, so demand dries up. The market loses momentum. The breakout collapses, trapping those who bought late. This is why Wyckoff emphasized reading the tape. Because the tape tells you who is in control. Large volume near resistance is often the result of two forces meeting at the same time: public buying and professional selling. When these forces collide, the chart shows it clearly if you know what to look for. The bar may have a long upper wick. It may close near its midpoint. It may fail immediately after. All of these are signs that the spike was distribution, not strength. By understanding this dynamic, you shift from being reactive to being analytical. Instead of chasing volume, you interpret volume. Instead of assuming strength, you verify it. And that shift in perspective protects you from countless losing trades. It also helps you develop the mindset of a professional. Patient, observant, and focused on reading intention rather than emotion. True operators reveal their intent through tests, not through dramatic moves. And this is one of the most important distinctions you can learn if you want to trade with the same clarity and confidence as the professionals. Most traders focus on the big moves, the breakouts, the sudden surges, the long bars that stretch across the chart. They assume that strength announces itself loudly, but the truth is the opposite. In Wyckoff's observations, genuine strength hides behind subtlety, behind quiet behavior, behind movements so understated that the average trader overlooks them entirely. When operators truly intend to move the market, they don't show their hand with explosive candles. They show it through the calm, controlled process of testing. A test is the market asking a question: is there still supply here? And the response, found in the behavior of price and volume, tells you everything. The professional trader understands that before any meaningful advance can begin, supply must be removed. Weak holders must be shaken out. Emotional traders must be flushed from their positions. And most of all, the path must be cleared so the dominant operator can mark up the price without resistance. That's why tests occur. They are the quiet cleanup operation before the main move begins. When a test appears, you will often see price dip into a previous low or into an area where supply used to show up. But instead of increasing in volume or accelerating downward, the move appears slow, controlled, and light. In fact, light volume is one of the clearest signs of a successful test. It tells you that selling pressure has diminished, that the composite operator has already done the work of absorbing supply earlier in the structure. Have you ever noticed how some of the best trades occur right after a seemingly insignificant little dip on low volume? That's not coincidence. That's intent. On the other hand, dramatic moves, the long green bars, the sudden breakout bursts, attract the public. They are designed to provoke excitement. But professionals don't need excitement to make decisions. They need clarity. A dramatic move does not prove strength. It proves urgency. And urgency is rarely a trait of the strong hand. When the market erupts suddenly, it often means someone is trying to create an impression, to lure participation, to trigger stop orders. True strength is never desperate. It does not need to shout. The test, by contrast, is quiet, almost whispered. It's a brief retracement, a small shakeout, a light probe into previous supply. And the key is not just the action, but the reaction. If the test shows that supply is gone, if price holds firm, if volume remains light, if buyers appear with ease, then the operator has the green light to move the market higher. This is why Wyckoff placed so much emphasis on last points of support, LPS and springs. Both are forms of tests. Both reveal operator intent. Both occur before the real move begins. Listening to the test requires a certain mindset, one that many traders never develop because they are too focused on price action that looks exciting instead of price action that is meaningful. A test doesn't catch your eye the way a breakout does. It doesn't feel thrilling. It doesn't make social media buzz. But if you think back to some of the best trades you've ever taken, weren't they often the ones that felt calm rather than exhilarating? Those calm entries usually came after the market whispered something through a test. Tests also reveal intent through repetition. Professionals don't rely on a single shakeout or a single probe. They test multiple times, each one absorbing more supply, each one clarifying the landscape. You may see a spring that dips beneath support, followed by a test that holds above that level, followed by another minor test on even lighter volume. To the untrained trader, these movements look random. To the Wyckoff trader, they form a sentence written by the composite operator. I am preparing to move the market. Understanding tests helps you avoid being seduced by dramatic moves. Many false breakouts occur with large volume and wide bars, but they collapse quickly because the underlying supply was never tested. The move was cosmetic, not structural. It looked impressive, but it revealed no true intent. Operators do not need to generate large bars to move price. They need only to remove obstacles, and once obstacles are removed, the price can rise effortlessly. Tests are also deeply tied to the psychology of trading. They require patience, not only from the operator but from the trader watching the chart. If you've ever felt an urge to jump into a position because you fear missing out, the test teaches you the opposite mindset. Instead of rushing, you wait. Instead of reacting to surface level excitement, you observe the deeper behavior. Instead of assuming that strength must be loud, you recognize that strength is often verified in silence. This shift in mindset alone can transform your trading because it roots your decisions in structure rather than emotion. Another key aspect of tests is the concept of effort versus result. During a test, you should see very little effort, light volume, and very little result, small downward movement. This combination is powerful. It shows that sellers no longer have the ability to push the market meaningfully lower. If sellers cannot move the market down even when given the chance. What does that tell you about the underlying strength? It tells you that the professionals have completed their preparation and that the path upward is nearly clear. When tests fail, when volume increases or price pushes too deeply into the range, it's a signal that supply remains. The test is not just a sign of strength, it is a diagnostic tool. It shows you whether the market is ready or not. Most traders focus on signals to enter, professionals focus on signals to validate the environment. A test provides that validation. Once you start recognizing tests, your relationship with the market changes. You no longer feel the need to predict. Instead, you read. You interpret. You let the market reveal its intentions before you commit your capital. You stop chasing the dramatic and start focusing on the deliberate.